All right, a lot to talk about today. Today was a very eventful day. It started off with the ECB meeting. By the way, before I get into this, just want to let everybody know that I sent out to my subscribers today my forecast for tomorrow's jobs report. If you want a copy of that, if you want to get that, just go to my website, pitbulleconomics.com, and sign up for a 30-day free trial of MMT Trader or Zombie Trading. And by the way, with zombie trading, the recommendation in there going into the ECB meeting today was to be aggressively short the euro. Zombie trading is my daily Forex signal service. We know how the zombies are going to behave, and we certainly called this one. We front run them, and we take their money, and we get out before they die. I also sent out an email to MMT Trader subscribers saying that the ECB meeting will result in selling of the euro. Now, let's get into this. The ECB announced, and it wasn't sure if they were going to come out with this or not, but they announced what was called a TLTRO, that's Targeted Long-Term Refinancing Operations. It's one of these monetary operations that the ECB has conducted in the past, and basically what it is extending low-interest loans to banks. In other words, incentivizing them to lend. Now here, again, we see the folly and the ridiculousness in all of this, because the ECB, just like all these other central bankers and these mainstream economists, they think that the lending is some liquidity issue. It is not. They also think that the banks lend out their reserves. Loans create reserves. The problem with credit demand in Europe is exactly that. It's a problem with the demand side, not the liquidity side. So the ECB is now going to extend these loans. This starts in September. And of course, the reaction was hyper negative in the foreign exchange market. For what reason? Really none other than just a belief system, a reflex reaction on the part of the vast majority of people active in the markets who believe this is somehow negative for the euro. So they sold it down. They sold it down to the lowest level. Well, it definitely took out the November low into the 111 handle. Consequently, we saw the dollar index rise to the highest level that it hit in this rally so far, which began, I guess, March of 2018. We got up to 97.71 on the dollar index, which I believe was the either the December high or the November high. I don't remember, but that has been the high of the move. We hit 97.71 on the dollar index. And just for your information, a 61.8% retracement, that's a Fibonacci retracement of the move of the dollar from 103.85, I believe, in early 2017 down to 88.25. That was the low of the move. A 61.8% retracement. Some people like that. It's a Fibonacci number. That comes out to 97.87. So we didn't hit that yet, but most likely we will see that. So today we got up to 97.71. Now, in the bigger, and by the way, I said back in January when the Fed paused the rate hikes, I said that's probably going to be bullish for the dollar. And notice the dollar's rise since that announcement, the end of rate hikes, the dollar has risen. Again, that is a total MMT explanation of what should happen. Now, most people, all throughout this entire period, we've heard this thing, when rates go up, the dollar goes up. No, when rates go up, the dollar was going down. And when the Fed started to contemplate and talk about ending rate hikes, the dollar started to go up. And as soon as they said we were ending rate hikes, the dollar went up even more. This is how it works. And this is how I've been saying it works for a very long time. What I have been noticing, by the way, and it's very disconcerting, I have to say, is that all of these central banks now are going what I am calling full Japan. And full Japan means exactly what the Bank of Japan has been doing for decades now, which is just dumping trillions and trillions of reserves into the banking system, thinking that somehow this is going to create the economic activity that they want or the level of inflation that they want. It should be very obvious to everybody now. After the trillions upon trillions, I think it's even in the quadrillions of yen that the Bank of Japan has pumped into the banking system, they cannot get inflation to rise above 1%. There is no connection between that and inflation. And on the contrary, what has happened is they have literally bankrupted their banks because those reserves, while they're considered non-risk assets, they factor into bank leverage ratios, which come under statutory guidelines, capital guidelines from the Basel III Accords. So you keep dumping these reserves onto the banks, they need to raise capital or they need to slow down their lending. This is exactly what's happening. None of these people, none of these guys at the central banks understand this. And here's Draghi at the ECB doing exactly the same thing. You know, this is the classic definition that Einstein said. You keep doing the same thing over and over again and expecting a different result each time. Monetarily speaking, what the ECB announced today, and mind you, they didn't commence with this measure today. They said it's going to happen in September, but everybody sold the euro anyway. From a monetary standpoint, this is probably neutral for the euro. It has no impact on what the exchange rate should be for the euro, but this is trading. These are markets. People react based on their beliefs. There was almost a universal belief that if the ECB did this, it is somehow negative for the euro, and that's what happened. So that's what happened. But the bigger, the bigger thing here is now the Fed has not just stopped rate hikes, but I think there's a chance now that the Fed is going to fall in line with the rest of these central banks and maybe even start to cut rates again. All of these central banks think that this is stimulus. Now, why is the inflation rate around the world at sub 2%? Because every single central bank in the world, every single major central bank in the world, with the exception of the Fed, has the interest rate below 2%. And when the Fed started raising rates beginning in December 2015, you saw the impulse, the inflation impulse started to pick up. You saw gold go from $1,043 an ounce all the way up almost to $1,400 an ounce. You saw the CPI go from negative year over year to up like 2.7% year over year. All of this followed the Fed rate increases. This is, again, classic MMT description of what is going to happen. And I've been saying this all along since I've been making these videos going back to December 2015. And I've been writing about it and I've been telling people about it. As soon as the Fed stopped, every other central bank decided to do the same thing and renew their quote-unquote stimulus measures, which is not stimulus at all. So that's it for the inflation impulse. You have the United States running big fiscal deficits, but it's not enough. It needs other, you got to have some of these other countries get into the mix, and it's just not happening. Now, China cut taxes, or they announced a tax cut that's so far been received in a positive way by the Chinese markets, but we'll see what is going to happen. But all these central banks are now looking like they're going full Japan, what I'm calling full Japan, and that's going to be a never-ending thing, just like it has been in Japan. They believe this is stimulus. As long as this is junk economics, folks. When you have junk economics, the result is junk. The output is junk. You're going to have slow growth as far as you can see, Japan-style growth, 1% growth, 1.5% growth at best, Europe-style growth with austerity and negative interest rate. This is what happens. Unless the fiscal situation picks up where the monetary policy is creating this drag, you need enough fiscal stimulus, enough fiscal support to offset the drag being created by monetary policy. So that's where we are. It's not necessarily bad for stocks, although it is going to make the stock market rise slow, difficult, labored. It'll rise. But it could have been a lot better if we had the proper policies which supported higher levels of economic growth. Now, there's one more thing I got to add in here. The debt ceiling in the United States, which we're up against now, the debt ceiling is back in effect. It is hindering the ability of the Treasury to drain reserves. So the Treasury can't sell bonds anymore because it's limited by the debt ceiling. And bond sales act as a reserve drain. So without the ability to drain reserves, you're going to get this steady reserve build in the banking system. And again, that's going to provide drag to the banks when it comes to their ability to create more loans. They're going to keep on lending, but it's going to slow down that process because of this reserve dump, and this is now tied to the debt ceiling. So the economy needs the loan growth. It is going to probably lead to slower levels of economic activity. All this stuff is being created by bad monetary policy and junk economics. So that's my wrap up for today. Bad economics. What can I tell you? But we've got to keep an eye on everything. And it looks now like it's going to just be a slow grind from here on out. We may even have the Fed. I mean, if you look at Fed fund futures, if you look out June, July, October, December, the probability of a rate cut is rising. Rate cut. And I wouldn't put it past the Fed now. Powell got scared out of his mind when we had that correction in the stock market in December. He put the brakes on everything. And the debt ceiling is impacting now, so everything's slowing down. I don't think it's slowing down to the point of recession, but everything is slowing down. Tomorrow we get the jobs numbers. If you want the numbers, if you want my forecast, go sign up at my site, pitbulleconomics.com, and I'll send it out to you. Plus, you get all the back copies of my report. Have a nice evening. Bye-bye.